The efficient market theory, it's a very important theory, and what it tries to capture, or what it aims to capture, is the relationship between information and prices. So, how is information reflected in prices? What happens when information changes? How do prices change? And the reason it's a very useful theory is because it can be used to help explain how, when new information is announced, as new information is revealed, it tells us how prices change and can get at the question of why actual returns and expected returns are often different. We've talked about unexpected surprises. This is a theory that helps identify and define how unexpected surprises would actually be expected to influence returns, such that there could be an unexpected surprise, and whether we'd expect that to help to influence returns to be particularly high or particularly low. So let's talk about information. We can classify information into three main types. The first is what we might want to call public trading information. It's public, it's available to the general population, it's out there, it's not something that hasn't been released yet, it's out there, people have access to it. And in particular, we're talking about trading information. Things like past prices, past returns, past volumes, how many shares were traded on a particular day. And so this is public trading information. It gets at trading activity for a particular asset. The second type of information is public. So again, it's out there. And we call this non-trading information. So this would essentially be all other public information. So these are things like um, financial statements, balance sheets, income statements, statements of cash flow for particular companies, demographic data that's obtained in government reports, um, industry analysis. A lot of times, reports are done that cite different statistics on market shares and things like that. Company press releases where companies announce their intentions to expand or their profits or things like that. And so this is public non-trading information. And finally, there's private information, which is information that's not public, that is known by a small group. It's often the insiders in the company. And so one example might be the company's involved in some secret merger negotiations, and the only the people that are involved in that know, and the market as a whole doesn't. Financial results that haven't been released yet. So, for example, companies doing its books, they know that they had net income of 83 cents a share. They're going to announce that tomorrow. Tomorrow is when it becomes public non trading information, but today it's still private information. So, those are the three main types of information. And we're going to talk about three approaches that investors can use. In two cases, it's okay to use, and insider trading shouldn't. Use to analyze information to determine asset values to help identify investing strategies, which stocks to buy, which ones to sell, and make investment decisions. So the first is technical analysis, and here you try to forecast future prices by looking at public trading information. And so what happens in technical analysis, oftentimes folks that engage in this are called chartists, and they'll often chart, they'll create a chart where they'll plot the closing prices of a stock, and then they'll, connect them, and they'll try to identify a pattern. And if they say, oh, this is the kind of pattern that is going to continue upward, we're in the middle of the pattern, and as the pattern plays out, the stock's going to go up, they'd want to buy it. Or if they recognize that they're in a pattern where the stocks, by continuing in the pattern is going to go down, they would go ahead and sell it. So by, identifying the direction, by identifying the pattern that we're in the midst of, can help determine where the stock is headed, and that's technical analysis. The key thing is it's based on public trading information. Simply looking at past prices, past returns, in particular, and drawing charts, and then identifying the pattern. The second is fundamental analysis, and this involves analyzing the public non-trading information to try to find the true value of a security and then comparing what the true value is to what the market price is. And if you can find a stock that, let's say, you think should be worth $20 a share and it's currently trading for $17 a share, you'd buy it under the idea that eventually the market's going to figure out what you've realized, and when that happens, the stock's going to take a nice run up. And so it involves analyzing financial statements, industry trends, analyst reports, right, to identify companies that should be bought. Or if in this case the price is 17 and you realize, hey, the price should only be 10, you would get rid of it because when the market figures that out, not going to be good. Insider trading is important. In particular, it is illegal and unethical. So do not consider it as a potential approach to investing, but it's important to look at in terms of market efficiency theory. And so here it involves forecasting the future price by evaluating private information. And the idea here is you've got access to private information, and you recognize when it goes public that that's going to change investors' perceptions or evaluation of the stock. And so if this is particularly good news, the stock will jump on it. If it's particularly bad news, the stock will tank on it. And so if you're here, if you think it's headed up, insider trader would buy, and then it goes up and they make a lot of money. If they think it's going to go down, they would get rid of it because once the announcement comes out, it's going to go down. So that's the idea of insider trading, but I cannot emphasize enough, it is illegal, it is unethical, do not engage in it. I don't know what more can be said.